Ever pondered how taxes, those pesky deductions from your paycheck, impact your wealth accumulation? Well, you're not alone. Many of us work hard, earn money, but see a chunk of it disappear into the abyss of taxes. But what if I told you that understanding taxes could actually help you build wealth? Intriguing, isn't it? In this video, we're diving deep into the world of taxes and wealth. We'll start by deciphering key terms like taxes, income tax, capital gains tax, and of course, wealth. Knowledge, after all, is the foundation of understanding. Next, we'll take a quick trip back in time to understand the origins of taxes and their intended purpose. History isn't just about dates and dead people. It provides context and perspective, especially when it comes to taxes. Now hold on to your hats because we're about to explore the complex relationship between taxes and wealth. We'll talk tax brackets, rates, and how different income levels are taxed. We'll also delve into how taxes impact individuals with varying income levels, and how the wealthy, through investments and tax planning, might end up paying proportionally less tax. To make things more relatable, we'll present real-life scenarios showing how an average person's wealth is impacted by taxes. And then, for a bit of contrast, we'll examine how a wealthy individual or a big corporation navigates the tax landscape. We'll also shine a light on tax loopholes and tax shelters, those secret passageways in the tax labyrinth used by the wealthy. This will lead us to a stimulating debate on the legality and ethics of tax avoidance. And since taxes are a global affair, we'll take a glimpse at tax systems and wealth inequality in different countries, and talk about the notorious tax havens. Finally, we'll discuss recent tax reforms and proposals aimed at making the tax system more equitable. Before we dive in, don't forget to like this video, subscribe to our channel, and turn on notifications so you don't miss out on our upcoming content. Stay tuned as we unravel the complex relationship between taxes and wealth. Before diving in, let's ensure we're speaking the same language. First off, what are taxes? Taxes are mandatory contributions to state revenue, levied by the government on workers' income, business profits, or added to the cost of some goods, services, and transactions. Now, let's break this down a little further. Income tax is the tax you pay on your earnings, plain and simple. It's based on a percentage of an individual's earnings and is taken directly from your paycheck. On the other hand, capital gains tax is a bit different. This is the tax you pay on the profit from selling something that's increased in value. For instance, if you buy a house and then sell it years later for more than you paid, you'll typically pay capital gains tax on the profit. Then there's wealth. Wealth refers to the total value of what you own, your assets, minus what you owe, your liabilities. Now, a little context. Taxes have been around since the dawn of civilization. The ancient Egyptians, for example, paid taxes in the form of grain, livestock, or labor. The purpose of tax has always been to fund public goods and services and redistribute wealth to reduce inequality. In modern times, however, the tax system has become a complex beast. It's not just about funding public services anymore. Taxes also play a role in shaping economic outcomes, influencing societal behavior, and balancing wealth distribution. In essence, taxes act as a financial tool. They can stimulate or slow down the economy, encourage or discourage certain behaviors, and either widen or narrow the wealth gap. Of course, the effectiveness of taxes in achieving these goals can be a hot topic of debate. It all depends on how the tax system is structured, who it benefits, and who it burdens. Now that we're equipped with the basics, let's delve into how taxes interact with wealth. It's time to dive into the crux of the matter. Our tax system operates on a progressive scale, meaning that as your income increases, so does your tax rate. Now, this might sound fair on the surface, but let's delve a bit deeper. For the average wage earner, income is taxed right off the paycheck. So, if you're earning $50,000 annually and you're in a 20% tax bracket, you're taking home $40,000. Simple math, right? But let's shift gears and talk about the wealthy individuals and corporations. Their income often comes from a variety of sources, not just a salary. For instance, they might have substantial earnings from investments, which are typically taxed at a lower rate than regular income. This is known as capital gains tax. Moreover, they might also have access to advanced tax planning strategies that further reduce their tax liability. For example, they might use tax shelters like retirement accounts, or they might take advantage of tax deductions and credits that are not easily accessible to the average person. So even though the wealthy might fall into a higher tax bracket, they don't necessarily pay proportionally more taxes. In fact, due to these strategies, they often end up paying a lower percentage of their income in taxes compared to the average wage earner. It's also worth noting that corporations often have their own set of tax planning strategies. They might, for instance, reinvest profits back into the business to lower their taxable income, or they might use complex structures to shift profits to low-tax jurisdictions. In essence, our tax system, while designed to be progressive, can often be regressive in practice. Those with higher incomes have the means to exploit the system's intricacies, often paying less in taxes relative to their wealth. So, taxes can indeed play a significant role in wealth accumulation. The key lies in understanding the system and knowing how to navigate it efficiently and legally. And that, my friends, is a crucial part of the journey towards financial freedom. Let's ground our understanding with some real-life examples. Picture this. Jane, a school teacher, earns $50,000 a year. After accounting for federal and state income taxes, Social Security, and Medicare, she might take home about $38,000. That's a significant chunk of her earnings going to taxes, leaving her less to save or invest for her future. Now let's contrast Jane's situation with a hypothetical example of a wealthy individual. Let's call him Mr. Rich. Mr. Rich earns $1 million annually, not from a salary, but from investments, which are usually taxed at a lower rate than income. After his accountant's diligent tax planning, Mr. Rich might end up paying just 15% in taxes. That leaves him with a whopping $850,000. Next, consider a big corporation like Megacorp. Corporations often have teams of tax lawyers finding every possible deduction, credit, and loophole. Despite making billions in profits, Megacorp could end up paying a surprisingly low tax rate, sometimes even zero. These examples highlight the disparity in how taxes affect different wealth brackets. Jane, Mr. Rich, and Megacorp all pay taxes, but the impact on their wealth is vastly different. Jane has less money to save or invest, while Mr. Rich and Megacorp can continue to accumulate wealth, often at a faster pace. This is not to demonize the wealthy or corporations. They are, after all, operating within the rules set by our tax system. But it does raise questions about the fairness and effectiveness of our current tax structure. And it underscores the importance of understanding how taxes work, so you can make informed decisions about your money. In the next section, we'll delve into tax loopholes and shelters, which are often used by the wealthy to reduce their tax burden. We'll also touch on the legal and ethical debates surrounding these strategies. Stay tuned, you don't want to miss this. Ever wondered how the rich seem to pay less tax proportionally? Well, let's dive into the world of tax loopholes and legalities. This is where the game changes for the wealthy. You see, a tax loophole is essentially a provision in the tax laws that allows taxpayers to reduce their tax liability. It's like finding a secret passage in a maze, a legal way to navigate through the complex web of tax laws to come out with more of your earnings intact. One common loophole is the use of tax shelters. These are investment vehicles that offer tax advantages, like certain retirement accounts. The wealthy often utilize these to defer or avoid taxes, allowing their wealth to grow tax-free until it's withdrawn. Another strategy is income shifting. This is when high earners shift their income from high tax categories to lower tax ones. For instance, rather than taking a high salary, which would be subject to a hefty income tax, they might opt for dividends or capital gains, which often have lower tax rates. And then there's the use of deductions and credits. The wealthy can often afford to make large charitable donations, for example, which can significantly lower their taxable income. But let's not forget about offshore tax havens. These are countries with low or zero tax rates, where corporations and wealthy individuals stash their money to avoid paying higher taxes in their home country. Now, here's where things get a bit murky. While these loopholes are currently legal, their ethical implications are a hot topic. Is it fair for the wealthy to pay less in taxes proportionally, while those with less wealth bear a heavier burden? It's a complex issue with no easy answers. On one hand, these individuals and corporations are simply playing by the rules set out by the tax laws. On the other, it's clear that these rules may favor those with the means to navigate them effectively. These loopholes, while legal, certainly stir a debate on fairness. And as we continue to grapple with wealth inequality, it's a debate that's far from over. It's not just about us. Let's take a quick glance globally. You see, every country has its own unique tax system and economic structure, and these can greatly affect wealth distribution. For example, Scandinavian countries like Denmark and Sweden are known for their high tax rates. However, they also have some of the lowest wealth inequality rates in the world, thanks to robust social safety nets funded by these taxes. Let's contrast that with tax havens, such as the Cayman Islands or Bermuda. These places have extremely low or even zero tax rates, attracting wealthy individuals and corporations from around the world. They offer secrecy and allow for massive wealth accumulation, often at the expense of other countries' tax revenues. These disparities in tax systems contribute to global wealth inequality, creating a complex web of financial flows and fiscal policies. As we can see, tax systems and wealth disparities vary widely across the globe. So what's next? Are there any solutions on the horizon? Well, various tax reforms have been introduced recently. For instance, we've seen changes aimed at closing some loopholes that allowed the wealthy to pay proportionally less tax. This includes stricter regulations on offshore accounts and the introduction of a global minimum tax. Moreover, there are numerous proposals on the table that strive to make taxation more equitable. One such proposal is the implementation of a progressive tax system, where tax rates increase as the taxable amount rises. This means that those with higher income would pay a larger percentage of their wealth in taxes, while those with less income would pay a smaller percentage. Other suggestions include increasing taxes on capital gains and dividends, which are often the main sources of income for the wealthy. While these reforms are steps in the right direction, the journey to a fair tax system is far from over. We've covered a lot of ground today, from understanding the basics of taxes and wealth to exploring real-life impacts and the legalities of tax loopholes. We've also looked beyond our borders, examining global perspectives and pondered over potential reforms and proposals. Now, it's your turn. We'd love to hear your thoughts and experiences on this complex relationship between taxes and wealth. Thank you for watching. Don't forget to subscribe if you haven't, and look out for our next video on smart investing strategies.